The 15th of June. Let's have a look at how the charts are this morning, and also we can discuss about the FOMC. Most importantly, that was the event we stuck around for last night, and that's still what really the market is digesting at this point in time. As you can see, the dollar a bit firmer this morning, consequently euro dollar already down to test S1 in the early part of trade. You can see this very volatile price action that we had, and we'll look at some of the reasons behind that in a bit more closer detail shortly. But also then cable a little lower amid some of that dollar strength still in the aftermath of the Fed. Elsewhere, quite the interesting thing though is if you were looking at the dollar strength and also the fact that equities are a little bit lower, gold also still down about $12 after what was a decline seen post-Fed. You would think, well, the markets are telling you by asset class movement this was a disappointment for those looking for a dovish hike. I wouldn't call it hawkish, more kind of neutral, but certainly that is reflected in those asset classes. The one that isn't quite fitting in that tune is T-notes, and maybe that's just a byproduct of the fact that equities moving lower. If the Fed are becoming less dovish, you would say then that would be probably more negative for equities, because equities tend to like the whole kind of lower for longer idea when it comes to looser monetary policy. If that starts to look like that's not going to be here in the near future, equities tend to move lower, and that weakness then might create then the more traditional inverse relationship between stocks and bonds. And so maybe some of that taken out from the initial spike high that we had on the weak retail sales report, where yields collapsed yesterday. The core inflation reading was particularly low, but otherwise, unlike the other asset classes which fully retraced, if not more, the move from yesterday afternoon, the 10-year still sitting up, for having found some support around pivot in the overnight session. The euro really, I think, tells the best story in terms of chart movement. And this was going into the FOMC. I was talking a lot about how the market was positioned and how we kind of thought that the market had jumped the gun a little bit in the fact that inflation was so weak. It kind of validated the market view that we're going to get a dovish hike. So the market took the poor retail sales report in combination with a trending lower inflation reading as a sign that the Fed are going to be unable to be particularly hawkish or in fact optimistic in their forecast going forward, and so therefore the market already jumped to that conclusion. Of course the risk then would always have been, what if the Fed just stay the course? And given the market had tilted so far in their dovish expectations, the market gets disappointed, and hence then you get a bit of reversal. Because there certainly was some dovish and hawkish elements in what Janet Yellen said last night. So let's have a little bit of a review of what exactly happened there. Firstly, this is the actual statement. What you're looking at here is the side-by-side comparisons. We were looking at this at the time yesterday, between what we had from the prior meeting to where we are at the moment in their assessment. And one of the interesting things here was that, and also reflected in the press conference, is that Yellen said progress that the economy has made is expected to make towards the maximum employment and price stability objectives assigned to us by law. Yellen also acknowledged that weaker inflation readings of late, but insisted they were significantly driven by one-off reductions in categories of prices such as wireless telephone services and prescription drugs. The committee still expects inflation to move up and stabilise at around 2% in the next couple of years. Now that last comment on inflation was particularly important, because yesterday this was the core inflation rate which we had, which came in at 1.7%. That was below expectations of 1.9 and marked the lowest core inflation reading that we've had since May of 2015. If you're looking at a trend, well, certainly since the beginning of the year, we have consistently seen inflation falling away. And certainly away from what would be the target of the Fed. If you're looking at here, this graphic, US inflation has met the Federal Reserve's goal in only 1 month since 2012. Maybe this is then one of the reasons why the Fed are willing to look beyond inflation being quite low, is because they've managed to hike rates now a couple of times, and only once has actually inflation been at or above target. So they still seem to be fairly comfortable with that. One of the main things that people are noting in the press this morning is that Janet Yellen pressing ahead with plans to normalise monetary policy, and this is where the main crux of the matter lies. She's betting that ongoing strength of the labour market will ultimately prevail over the recent weakness in inflation, and that's really key. When you're looking at these projections, these were the ones we were looking at the time of the release, you saw that PCE inflation, the core PCE inflation readings, were downgraded fairly substantially. The core reading by 0.2, and even to a more deeper extent in the PCE inflation. However, what the Fed see is this temporary dip, only then to come back in the medium term. So therefore, they're actually seeing through the weakness at this point in time and continuing to stick on track with their rate hike expectations. If you were looking at the dot plots, this is when you go down to the bottom of the table, the federal funds rate. So this is the June forecasts, unchanged against March, 1.4 this year. So they're still expecting, as far as the Fed are concerned, another hike this year. Now, question of timing, most of the bank research that I'm reading this morning is now suggestive that December would be an opportune time. Focus will be on September and December. That's when you get these updated summary of economic projections and the press conference with Janet Yellen, which is typically when the central bank likes to act on policy. So unchanged 2017, same for 2018 and the longer run, and only a very minimal change that really equates to nothing in terms of 2019. Looking graphically then at what this dot plot trajectory looks like for rate increases from the Fed, the actual curve, if you like, if you were to draw that on this chart, is pretty much unchanged. So they hiked rates. That was completely as expected. Remember, we were pretty much 100% priced in. That was not by any means surprising. The dot plots, again, we were only looking for minimal changes. Now, the one thing that was interesting was that, yes, they downgraded the inflation forecast here, which would be dovish. However, the following commentary then suggestive that actually they're willing to look through that temporary lower part of inflation. The next really important part, which really contributed to the move in the euro currency and caused this big reversal, was the key words of the balance sheet. This is kind of the next step as to tightening of monetary policy as far as the Fed and the US are concerned. And what they did yesterday, which was actually one of the most notable developments, was the FOMC announced a decision is likely to proceed with the balance sheet wind down later this year. They previously had not been that specific in terms of the timeline. They then went on to further outlay details with some guidance as to the process that the Fed expects to take. So this is definitely a more hawkish development because the discussions on the balance sheet have progressed to the point where they now have a plan in place. This means then that those looking for a dovish hike were disappointed. That amplified by the pre-positioning movement you had on the weak data, and we had a complete reversal all the way back to net zero, if you like, to where we were by the time that Janet Yellen had finished delivering and the US closed last night. And we've had a little bit of follow through again this morning. So hopefully that kind of explains a little bit about the Fed, why the market moved like it did. Gold certainly had a really strong move to the downside on the back of this latest development, but overall, if you were looking at when the US data came out yesterday to where we're trading at the moment, we're only about $4 off or $3 off where we were. So despite the volatility that we've had, realistically or in retrospect, we're not actually too far from where we were this time yesterday. What I'll do is I'm going to pass you over to Sam shortly, and he's going to talk you over some of the setups that we're looking at for today. Okay, just going back to a couple of other headlines then away from the Fed, so that you're aware. There has also been this story that's developed overnight. So the special counsel investigating Russia's interference in the 2016 US election plans to interview 2 top US intelligence officials about whether Donald Trump sought their help to get the FBI to back off a related probe of former National Security Advisor Michael Flynn. It's according to 3 sources. Now, just when you thought that Comey and the impeachment risk had gone away, well, it's just come back round again. It will be interesting to see how the US start to interpret this type of development. But certainly the reason why this is important is because the move expands the scope of the special counsel's investigation. Essentially, now it appears Mueller is examining the president's own conduct, which may include whether Trump tried to obstruct justice. So this goes back then full circle almost as to what James Comey was apparently said to be investigating at the time, before of course he got fired. So I'd keep an eye on this, maybe as well with US equities a little bit softer. Not only have you got slightly less hawkish or less dovish, excuse me, FOMC announcement yesterday, you've also got potentially a bit of return of the Trump risk on investigation and relationships with Russia leading into the election last year. So something to just consider. Looking at the calendar for today, there is a couple things coming out later, and this leads us in then to the Bank of England, which we'll just talk about here shortly. 9:30, I'll be keeping an eye on the sterling currency. You do have UK retail sales report. If you're looking at a month-on-month reading, we're looking at a negative 0.8%. That's against a previous positive 2.3. So we are looking for a deterioration in the retail sales number over the course of the previous month, that being measured over May. This then leads us into the Bank of England interest rate decision. I would imagine all economists are expecting no change on the rate or the QE. That's not really the question mark here. The question is more the commentary. Because if you remember with the Bank of England, they announced rates and the QE. They also announced the vote split, i.e. there's 8 members at the moment. Remember Christine Forbes, her term is due to finish at the end of the month. So she still, as I understand, has the ability to vote in this particular meeting, this being her final one. She has been the lone hawk, dissenting from the pack and voting for a hike now for a couple of months, and I expect that to remain the same. So in terms of the split, there's 8 MPC members. You're probably looking for 7-1, I think is going to be expected. I wouldn't say either the rate, the APF or the QE number or the 7-1 will really be particularly market moving. The commentary is what will be key. Now, from a Bank of England point of view, we are in between those key meetings. We talk about the Fed when we have the dot plots and Yellen, that being March, June, Sep, Dec. Well, in the UK, the quarterly inflation report is our equivalent of that situation. Now, the next quarterly inflation report is not until August. So this meeting is kind of off cycle, if you like. We had a quarterly inflation report in May, the next one comes in August, and typically the central bank doesn't tend to take much action in the interim periods, because what the benefit of August will give you is updated forecasts from the bank and also the ability of Mark Carney to be transparent as well as answer Q&A questions to alleviate any uncertainties the market might have if there's a change in policy direction. What I'm expecting from today's report is really how did the Bank of England assess the situation of this? And this is what we had, of course, earlier in the week. UK CPI is now 2.9%. That was higher than expected, 2.7. It's the highest inflation rate, in fact, since June of 2013. And we are 0.1% away from Mark Carney then having to write a letter to the Chancellor, Philip Hammond, to explain why they're so far away from, of course, their target of 2%. Now, one of the key phrases here that I think will probably be maintained is that there are limits to the extent in which above target inflation can be tolerated. This meaning then by a sentence or a phrase that if inflation continues to go up, there's a threshold of when then the Bank of England will take action. That as a statement would be deemed as hawkish. The only problem that this inflation issue is having for the UK economy and consumer though is obviously this one. And this is what we had yesterday. And this is talking about the increasing pressure of which household and individuals' incomes are coming under, record low savings rates, the divergence between the cost of goods is rising comparative to wages, which if anything is falling, creating a bigger divide that then likely to sap consumer confidence, will restrict the ability of people to spend, companies make less money, they invest less, and then you go into this economic kind of downturn as far as the UK is concerned. So this is obviously going to be troubling for the Bank of England. The other thing, and that's key here, is about the political uncertainty. At this point, we do not know the shape or form of the government. It's looking likely that the Conservatives will team up with the DUP, but then the bigger factor at play here is what would be the situation then going into negotiations with Brexit. And with all these uncertainties, you would think that the Bank of England will likely want to keep that phrase about a tolerance of inflation, but overall I'd be expecting potentially a more conciliatory tone for the Bank of England. I think they've got more to be worried about than they've got to be optimistic about at this point in time. That would probably translate then to being neutral to dovish, but more so on the side of let's just wait and see and have clarity on a lot of these trends that are forming economically and also politically. That's at 12 o'clock. Again, it's a one and done affair, so midday we'll get the Bank of England. Other than the Bank of England, it's Thursday, so you get your regular weekly jobless claims. You also got Philly Fed later on this afternoon and US Empire State Manufacturing. I'd say though in the context of the FOMC last night, unless these are wildly out of line, I wouldn't be looking for too much out of this data point, or these data points. Okay, back to the charts. I'm going to hand you over to Sam. He's going to jump on now and just talk about a few of the charts that he's looked at this morning. Maybe a few interesting levels for you guys to keep an eye on. So, wish you a good day.
Bottom left one.
Yeah, it's just the bottom left.
Yeah, hi guys. Just we're having a look just recently now at pound. Actually, we just made our way down to yesterday's low to see. It'd be quite interesting to see how we hold ahead of the meeting later today. But being below that, you have an interesting support area, which is pretty much bang on S1. So while we've sort of been in this, albeit quite big range consolidation area, post the election, it'll be interesting to see what happens later today. Pivot looks quite nice as well technically, and to be honest, anywhere between S1 and the pivot, I think it's probably better to leave alone and wait for that to come. Above the pivot, you can see there's a bit of free room for it to go up to 128 in R1, and below S1 quite a bit of room to go down to S1 if it can get through that 127. So the pound looks quite nice if we can get a break out of this intraday range and then possibly to the extremities of the post election one as well. DAX is quite interesting to have a look at here. Let me just get the chart. I'll do it over here. As we pushed down quite heavily this morning, and let's make this chart a bit bigger, you can see we're sort of trending down lower, coming back to the low that was made here. If I just get a trend line on this here, not the best trend line, it's just a quick rough one drawn, but it'll be interesting to see if we can push lower or is this the low for the morning, we start pushing back higher. To see what happens there. Failing to push higher, S2 there before we really get to the sort of the lows that we've had from the last couple of weeks. So equities on the back foot this morning. S&P finally breaking through the S1 it looked like it was going to do, coming back possibly for the classic there. If it hurts you too much to short equities, there's a good sort of area, or support area it looks like, down at S2 with the lows pretty much bang on from the 12th. As for the S&P, the Dow looks quite similar in a setup as well, albeit just below the S2. So if we can push further below, it might be a case of waiting for the afternoon again for this to really kick on. But S2 looks pretty nice for both the Dow and the S&P to continue the overall trend of this market, albeit rather mixed the last couple of days. Nasdaq, following the large sell-off we saw on the 9th, S2 doesn't look as good as the other equity pairs, but I think still worth considering if we can make it down to the low here that you see on the 12th as an interesting support area for all equities. Now, and I'll just have a quick look back at S&P, sort of playing the overall theme from yesterday of this more hawkish sort of statement. If we can make our way back up to the pivot today, I think as well that looks quite good for a short. But definitely in the S&P, using today's high, you've got the Dow Jones, which looks a bit more messy, to be honest, and then the Nasdaq looks quite good if we can make our way back up there. But again, it might be a case of waiting really for the afternoon for these markets, these plays to sort of come in. Or gold, has worked pretty well from the pivot. It took a while to sort of materialise after 7 o'clock. This further down move after breaking the pivot last night. Today's pivot has held quite well, so I'll be marking up yesterday's low. I'll be marking up the pivot, albeit the high of the day, to see how we can go from there. Obviously, if you were to drop the time frame down, there may be a couple of half decent moves here and there, but I think just worth for gold, just really treating the high as a potential area for price action, or yesterday's low, and really sort of perhaps leaving it unless we can break the low of the day with quite a lot of significance. Oil, I was looking at probably the best level to me looks like the pivot, because it also lines up with, if I was to make this chart maybe a tiny bit bigger time frame, you can see the lows from the 8th pretty much bang on today's pivot level. So if we can make our way back up there, I think technically looks quite good. And you're also there following the trend of the market since, well, really 24th of May. So technically looks good. Sentiment following, trend following, quite like it. Again, time of the day will be significant to sort of want to take that trade on. Failing to get up there, you've got to break the low down to $44 in S1, and when we do put this chart in a longer time frame, well, I have to put it maybe here. You can see these lows not seen for a while, and it was around about here, so just above today's S1, $44.12, where you'll start to hear comments out of OPEC. So I'd be very wary if we can get down there. $44, the low of the 24th, I think it was, acting as a possible good level of support. Definitely the first test is going to be quite strong there. As Ant mentioned, T-notes perhaps being supported here due to the equity move down at the moment. How to sort of play that, I think when a market's doing this, you almost want it to come to you and let it make its decision for you. So the way to do that, I would be marking up this overnight high, morning, midnight high. I'd be marking up obviously this low here. Let me just circle these for you around here, and obviously considering the pivot yesterday's high as well, and saying, well, look, if we can get a breakout of these areas, then there's a potential opportunity. Again, time of the day for the a break high or low in T-notes, you're probably going to want it to be post sort of 120, the open there, to have any real significance. But I'd be quite wary. Even if we do break lower, you've got previous highs to come through, so it might be a case really of, unless there's the momentum there, really staying away from T-notes, I'd say, for now. Just going to look at euros, I don't believe I touched upon that. That's coming to an interesting area. It almost made S1, I suppose it sort of came into that zone. You've also got the low of the 9th just below there, which in a relatively range-bound market for a month now, you know, albeit a couple of spikes here and there, could be a potential area to go long. I mean, we have unwinded this sort of dovish hopes perhaps the market had, so a bit of dollar strength coming back into play. So it might be worth, you know, looking for a retracement higher to look for a short. You know, where could that be? Obviously, we've just broken through yesterday's low around the 112 handle, or up to the high of the day, and the pivot doesn't look too bad as well. You've got previous day's highs on today's high. Let me just move that out of the way to consider as well. So, case of probably with the the data out, coming out soon. A couple of the equity markets looking good. If we can get pullbacks or down to, I think was the S2s we were talking about, S2 down there. Probably a case of just sort of waiting and seeing what happens, and then going from there. So being reactive, kind of reactive day to what the market does, because that would probably be the safest sort of option. I think the trade I like the most out of everything is that short oil pivot. If we can get up there, of course, bearing no comments out of OPEC, which would obviously move the market short term. Any questions? I'll be logging into Trading Live, so do feel free to ask me, or guys in house, give me a shout. Yeah, that would be the trade I'd be looking for there. The others I'll be waiting to see if we can get sort of breaks out at the range, whether that be to continue the trend or reverse it as well.